In this episode of Center for Tax Studies Individual Income Tax course, we are going to talk about when you actually have to file. Surprise, you sometimes don't have to file a tax return, and what the types of filing statuses are. So let's get started. So there are a couple of instances in which you don't have to file a tax return. If you make under the standard deduction that is applicable to you and your personal exemption and any dependency exemptions that are allowed for you, you don't have to file a tax return. The additional standard deduction does apply when determining whether or not you have to file. So for example, let's say that your client Sam is 66 years old and is single. During tax year 2016, he made $10,000 of earned income from his employment at Sam's World. Does he have to file a tax return? And the answer is no. This is because if you add his personal exemption of $4,050, his standard deduction of $6,300, and his additional standard deduction of $1,550, the total amount of money that he can exclude from income before it's taxed is $11,900. Therefore, the earned income that he made of $10,000 is less than that $11,900, and therefore he doesn't have to file a tax return. Now, if you are a self-employed, the rule is a little bit different. If you make over $400 of self-employed earned income, then you have to file a tax return because you are subject to self-employment taxes. Now, what if you are the dependent of another? You must file if you have earned income that exceeds the standard deduction as calculated for a dependent. The standard deduction of a dependent is calculated as the greater of $1,050 or earned income plus $350, but that does not exceed the basic standard deduction for that individual, and that is the maximum. So essentially, if you make over the standard deduction for a single individual, then you have to file a tax return. So let's talk about filing status. There are 4 classifications of filing status and 6 ways in which you can get into one of those 4 filing statuses. Filing status is good for a couple of things. It determines what standard deduction you can get, whether you must file a tax return, the taxpayer's tax liability because tax rates are different depending on what filing status you are, any reduction of exemptions, itemized deductions, and certain tax credits, as well as eligibility for certain provisions. For example, some credits are not available when you are married filing separately. So the types of filing status that you can use are, number 1, single. So if you are single, you must be unmarried, including being legally separated or divorced. They're a little bit different. Marital status is determined on the last day of the year. If you are divorced in 2016 in June, then you are single for that year. Also, you must not have a dependent, as we discussed in a previous episode. Married filing jointly, however, began in 1948 in response to community property states. Community property applies in a couple of different states such as California, Arizona, etc. And it applies only if you put down that you are community property in your legislation. So community property means that if one spouse earns money, both spouses are deemed to have earned half of whatever that amount of money was earned by the marriage. Prior to 1948, could claim that they earned half the amount of income that one spouse earned because that one spouse had earned the money for the marriage. So if you made $80,000, each person would state that they had earned $40,000 and as a result would not be subject to as much tax as somebody in a common law state who, if they earned the same amount of money, would then be subject to more tax. So in 1948, Congress started the married filing jointly status so that it would put everybody on common ground. Now, married filing jointly is for those who are part of a civil marriage, a common law marriage where two parties live together and they state to the world that they are married even if they have not gone through a formal ceremony, as well as gay marriage as of June 2015. This does not include civil unions or domestic partners. If one of the spouses dies in a given tax year, you are married filing jointly as of that tax year. Now, some people would prefer not to have married filing jointly status because you have joint and several liability. So if your spouse is a little bit sketchy or a little bit shady and you're not sure as to if income is actually being included, you may want to file separately because you have joint and several liability for any tax liability that is not collected. So what that means is that the IRS can go after you or your spouse to get the income. So if you were to divorce and several years later the IRS comes back, they can come after you for your spouse's tax liability. Now there is innocent spouse relief, which is provided by the IRS in the event that one spouse did not know of the other spouse's fraud, but it is a hard standard to meet. Additionally, once you have chosen married filing jointly status, you cannot switch in an amendment to married filing separately status. So what is married filing separately? Married filing separately means that each party reports his income, exemptions, deductions, credits, and taxes paid separately. However, if either spouse itemizes, the other spouse must itemize. This is to make sure that there is not double dipping, that the whole purpose of trying to avoid the situation that had occurred prior to 1948 with community property, they want everything to be equal for married filing separately. Additionally, you also do not get to take the credit for child and dependent care expenses, the earned income credit, as well as you don't get to take any deductions for student loan interest paid. When you are married filing separately, if you are in a community property state, you must report 1/2 of all income incurred by either spouse. However, this does not apply to amounts earned after a separation and prior to divorce. So when would you want to file married filing separately? Well, this is when you have significant medical expenses that are incurred by one spouse subject to the 10% of AGI limitation. So if you are in a higher tax bracket, you make $150,000 and you have less than $15,000 of medical expenses, but enough that if you were to divide equally the amount of income that you incur, you could then separate the type of itemized deduction between each of the parties. So now what if you are a surviving spouse? A surviving spouse means that you are married in the year of death. You may file a married filing jointly return if the survivor is the executor or the executor agrees. This makes it so that you don't have to file as either head of household or file single because you get better tax rates. Additionally, you may file using the joint return rates for 2 years following the death of one spouse, as long as you maintain the household for a dependent child. All right, so now what if you are single but you have a dependent? This gives rise to the head of household filing status. You must be single. You must provide more than 1/2 of the cost of maintaining the household. Additionally, your household must be the principal home of a qualifying child or dependent relative. So therefore, the dependent must live in the house for more than half of the year, and the dependent must meet the actual relationship test, not the living with the taxpayer for the entire year part of the relationship test, if you are meeting the qualifying relative test for your dependency exemption. There are 2 exceptions, however. If you have an unmarried child An unmarried child need not be a dependent if the custodial parent gave the dependency exemption to the other parent. This was in our previous episode on dependency and personal exemptions. The other exception is for your parent. So if you are the taxpayer and you want to claim head of household status and you want to claim your parent as a dependent, the parent does not need to live in the home. For example, they can live in a nursing home and you can take care of that dependent and claim head of household status. Now, if you are an abandoned spouse, your spouse has not actually died, you can be treated as single and have either head of household status or the single filing status if the taxpayer does not file a joint return with you, you have paid more than 1/2 of the cost of maintaining the home, and your spouse did not live in the home during the last 6 months of the year. The home was the principal residence of the taxpayer's child for more than 1/2 the year, and the taxpayer could claim the child as a dependent, even if there wasn't a written agreement giving the dependency exemption to a non-custodial parent. This allows you to be classified as single and not have to file as married filing separately, and you can file as head of household and receive better tax rates than married filing separately. Okay, so my camera just died, so you may hear a little bit of a difference in the sound quality, and you'll see me in a little bit and I'll look a little different, but let's get started with some examples. So what is the taxpayer's filing status for 2016 if the taxpayer's husband died in December 2016 and she is the executor of his estate? Well, she may file as married filing jointly, because as the executor, she is giving permission to be able to file married filing jointly in the year of death. Now, same as above, except let's assume that husband died in 2015 and taxpayer maintains a home in which her dependent sister resides. Here, she must file as head of household because she does not have a dependent child. Now assume again, same as above, except that the household also includes husband's son, who is taxpayer's dependent. Well, now she can file as surviving spouse using married filing jointly rates. Let's assume another set of facts. Taxpayer was abandoned by her spouse in 2015, and she maintains a household which includes her 2 minor children who are her dependents. Here, she can be considered as single under the abandoned spouse rules because her husband did not live with her for the last 6 months of the year. She has a child which she can claim as a dependent, and she doesn't file a joint return with her husband. Because she is considered single, she can qualify as head of household because she maintains a household and she has a dependent living with her. Alright, so that's everything that you need to know about filing requirements and filing status. If you have any questions, feel free to leave a comment in the comment box below, or you can email me at centerfortaxstudies@gmail.com. If you liked this episode, please give it a thumbs up and feel free to subscribe for more episodes like this. Thank you so much for watching, and we'll see you next time.